Welcome to the Freedom Capital Management Strategies Market Review and Outlook. I'm Brian Zbor, Investment Director. I'm here with Pete Murphy, Chief Investment Officer. Pete, we saw really strong equity markets for the U.S. International markets were up, but somewhat lackluster returns, and we thought 2024 was going to be a good year for bonds, but again, we saw some modest performance. Could you start with the U.S. markets, and what was the drivers of the strong equity results?
Absolutely, and thank you all for joining us. As Brian mentioned, it was another great year for U.S. stock market investors. The S&P 500 rose by about 25% in 2024, and that comes on the tails of being up over 20% the year prior in 2023. A really exceptionally strong two-year period for U.S. stock markets. And when we look under the hood of the key drivers of these strong stock price gains, there's really two things that stood out last year. The first is the strength of the U.S. economy. We spoke multiple times last year about how resilient U.S. economic growth has been, and we've seen that with growth strong, unemployment low, corporate earnings robust. It's been a strong U.S. economy, which has translated into a strong U.S. stock market. On top of that, we also had inflation meaningfully moderating last year. And that also proved a very powerful force for U.S. stock markets. That combination of strong growth plus moderating inflation led to stock prices rising sharply higher.
That's a great recap. Moving to international, we saw somewhat of a decline in the fourth quarter. Results certainly lagged the U.S. What were some of the drivers for this underperformance?
It's remained an underwhelming story in international equity markets now for much of the past decade, and 2024 continued that trend. While the markets were mostly up modestly on the year, they significantly lagged their U.S. counterparts, and there were a couple key reasons that drove that. First and foremost, the two largest economic regions overseas, Europe and China, are both struggling in different ways. I'll start with Europe. Europe has suffered from below trend growth or weaker growth in the US for many, many years now. Part of that's a demographic trend, part of that's a productivity trend. But weaker growth in Europe has led to disappointing returns in European equity markets, and that continued last year. When we move over to China, China has been struggling in a meaningful way the last couple of years, and that continued last year. They're struggling from an overbuild in the housing market that is really weighing on the economy, much like it did in the US about 15 years ago. They're also suffering from a poor demographic outlook, and growth has been weaker than expected. So when you take those two regions and you look at the economic conditions there, they continue to struggle, and their equity markets reflected that last year.
Pete, that's a great recap of the equity markets. Turning to the bond markets, was another lackluster year. What were some of the key factors in the underperformance?
It was a disappointing year and a disappointing fourth quarter for the bond market. So I'll start with the fourth quarter. In the fourth quarter of the year, the Bloomberg Aggregate Bond Index, which is the benchmark for U.S. bonds, declined by about 3%, which is a really negative quarter for the bond market. And when we look at what drove those price declines, it really happened primarily after the re-election of President Trump. And what came with that is expectations for the potential for higher economic growth, the potential and prospect for renewed inflationary pressures, and finally the potential for an expanding fiscal deficit. And that combination of factors led interest rates to rise. And when interest rates rise, bond prices generally decline. And that played out in a sharp and meaningful way in the fourth quarter of last year. When we zoom out to the full year of 2024, the picture is similar, but there's a few nuances I'd like to bring to light. First and foremost, many investors entered 2024 very optimistic about bond markets, with expectations that inflation was under control and beginning to moderate, and with that interest rates were likely to begin declining. And if interest rates decline, bond prices generally rise. And so that's what the market was expecting in 2024, and it really just didn't pan out that way. When we look at the full year, the Bloomberg Aggregate Bond Index, while it rose about 1.25% for the full year, that wasn't nearly as high as the yield that was on offer at the beginning of the year. And the reason for that is that interest rates and the 10-year Treasury, which is the yield that is most widely followed, actually rose over the course of last year from a starting point of about 3.9% to 4.6% at the end of the year. So it's that increase in interest rates that really pressured bond markets and led to the lackluster results. And that's something that many investors are going to be focused on in the new year as well, as I'll talk about shortly.
Pete, that's a great recap of 2024. Looking out to 2025, investors are coming in very optimistic given the strong performance last year. However, we are seeing with President Trump a lot of strong policy initiatives, potential changes. How do you see this all playing out?
Great question, Brian, and it's what's on the mind of most investors as we enter the new year. So I'll first start with the optimistic state that investors find themselves in as we enter the new year. When we look at the market, the S&P 500 has risen over 20% for 2 consecutive years. That's a pretty historically strong period. The last time we saw that was in the late 1990s during the heyday of the technology bubble. So these are really exceptional results that U.S. stock markets have delivered the last couple of years. On top of that, we've got a really strong U.S. economy. The economy has been growing faster than expected for the last couple of years. We have strong growth, we have low unemployment, and we have moderating inflation. So a really strong combination of factors in the economy that we've seen playing out in recent years. And with that, not surprisingly, comes greater expectations. And greater expectations are going to reset the bar higher for the economy and markets. An example of that is corporate earnings. And right now, investors are expecting corporate earnings of the S&P 500 companies to grow by about 15% in 2025. That's a very strong rate of growth and much higher than average for company earnings growth. So that's something that investors are pricing in at this point, meaning that the companies are going to have to exceed that to really raise the bar further. Secondly, we look at how is the market valued, how is it priced? And when we look at that, we look at something called a price to earnings multiple. And currently the S&P 500 is trading at about 22 times expected 2025 earnings. That's a pretty healthy multiple at 22 times. So there's a lot of optimism being priced into that strong earnings growth I just talked about. So when you put that picture together, there's a lot of optimism, and for good reason, but the market's going to really have to see some great results to grow into that optimism over the course of 2025.
Pete, that's a great recap of investor optimism coming into 2025. Could you transition into some of the policy changes that could be coming this year?
No doubt that this is top of mind for investors as we enter 2025. The incoming Trump administration has strong policy proposals for significant potential changes, and most investors are asking what policies will be implemented, when will they be implemented, and ultimately what impact will they have on the economy and financial markets. And that last point's an important one because the economy that President Trump is coming into in 2025 is quite a bit different than the economy that he inherited in 2017. As I spoke about earlier, the economy today is in a strong position. It has been growing strongly. The stock market has had a period of exceptional strength. These conditions are very different than the period before 2017. And so when we look at the market reaction so far the market seems to be expecting the same type of outcome as during Trump's first term. We saw U.S. stocks rise sharply after his re-election. We saw international stocks decline. We saw fixed income markets struggle and interest rates rise. So that was kind of the combination that we saw in the first time that Trump was elected, and markets seem to be pricing that again. But with the different conditions today, we still think there's a lot to be written. So some of the policies that will likely be optimistic or potentially constructive in our opinion, involve deregulation and tax cuts that have the potential to accelerate economic growth, improve productivity, and by reducing red tape and increasing business confidence. That would be a pretty constructive set of factors if those policies are implemented that way. On the flip side, there's some potential policies that could be challenging for the market and the economy. Some of the proposals around tariffs and trade policy, some of the limitations to immigration policy have the potential to disrupt the flow of goods and services and also to disrupt the labor market. And after we recently had a period of an inflation shock due to some of these type of factors, the potential fear of those type of factors playing out again could spook markets in the new year. So for investors, there's a lot to still be written, and it's going to be important in 2025 to be more focused than usual on some of the policy prescriptions coming out of Washington to see how they may impact the economy and markets.
Pete, thank you for those insights. Is there anything you'd like to leave investors with how to navigate the current market environment?
As always, as we enter the new year, the future is unknowable. There's a lot of factors that could change over the course of the year. And as we enter 2025, we're clearly in a strong posture as it relates to the U.S. economy, as it relates to the U.S. stock market. And what we'll be watching most closely is how does the new administration come in and impact potentially the economic situation in the U.S. and at large. It's going to have a significant impact, and there's much to still be written. But as always for investors, the future remains unknowable, and it's important to stay disciplined, remain diversified, and to stay engaged with your financial advisor to make your financial plan a living plan.
Pete, thanks for all those insights. Thank you for joining us today. We hope you have a happy and healthy 2025.
Thank you.